All right. Today I want to talk about Chapter 7, excuse me, which actually includes quite a bit of information. And I'm going to point out the things that I want you to cover and the things that you don't have to cover. Um, this is one chapter where I think you need to read the words in the chapter and don't spend much time on the problem illustrations trying to figure those out until you've read through the chapter and you kind of have an idea what's going on. In the last chapter, we covered periodic inventory, meaning the company did not have an inventory system. So they had to keep track of their purchases and returns, etc., and calculate their cost of goods sold. In this chapter, they go over the entries if you have a perpetual system. That is, you have an inventory system. Every time you sell an item, it automatically puts the sale price in and the cost in. So you have everything going in right away, and you're not having to calculate that cost of goods sold at the end of the period, whatever the time period might be. Now, I'm in the very, when I'm doing this online, they don't give me page numbers, but objective number 1 under the importance of proper inventory valuation. If you can remember from the last chapter, what we did was come up with all of the cost of the goods available for sale. And as I said in that lecture, what you had available for sale, you either sold or you didn't. If you didn't sell it, excuse me, it went into ending inventory. If you did sell it, it went into cost of goods sold. So what they're pointing out here is if you put in the wrong ending inventory number, then you're going to have the wrong cost of goods sold number, which of course gets subtracted from revenues to give you your gross margin or gross profit. So if a company wanted to, they could distort their ending inventory numbers to distort their income numbers. So there's over time, historically, there have been a lot of really large inventory fraud cases. Dunkin' Donuts was one. Verizon, I think, was another. And that's going to be your next group project, is to research an inventory fraud case and put it in discussion board. But anyway, so do read through this, the importance of proper inventory valuation. And they give you an example. Again, I wouldn't worry too much about all of that right yet. Now, all companies have to take an inventory at the end of the year if they publish financial statements to the public. And how they decide to value the inventory at that date is going to be covered in this chapter. I'm going to skip through that. I don't care too much. What you're going to be covered on is the stuff that I talk on. If I don't talk on it, you can kind of move over that. For example, in the last, when they started talking about all the costs in inventory, well, you already know that, I think, for the most part. Then on the after they go through inventory evaluation under changing prices, you don't need to worry about that. That's a higher level subject than most people in this class need, because most of you are business admin majors. Now they start at on the bottom of this screen. I don't know what page in the book. Perpetual inventory procedures. We talked about periodic, and now they're talking about perpetual. So I'm going to skip over here to this page. You can read through that. I think it's going to confuse you. You should just go right over here to the page where it says comparing journal entries under the periodic and perpetual inventory procedures. All right, in periodic from last chapter, we did debit purchases, credit accounts payable. If you have an inventory system, it's debit merchandise inventory, credit accounts payable. So inventory is used in place of purchases. On the sell side, you're the seller. Under periodic, you debit accounts receivable, credit sales. Under perpetual, you do the same thing, but then you have an entry going in that is debit cost of goods sold. That's the cost of the material you sold, and it takes it out of inventory at that time. Over here, we can't do that because we don't know the cost of the goods that we're selling because we don't have a system. And Now the next one is for return. Over here, we debited accounts payable, credit purchase returns and allowances. Now you debit accounts payable, but you credit merchandise inventory. You have an inventory account, put everything in that account that you can. Okay, over here is if there's an allowance. Okay, so that's the same thing. Yeah, I don't know. I'm thinking, well, an allowance or a return, either one, they're treated the same way. Okay, and on the freight charges over here, we called it freight in or transportation in and credit cash under periodic. And they included a return and allowance in there. Over here, the cost of the freight goes into inventory. So the difference is over here it goes into freight or transportation in, it's actually called freight expense. And over here it goes into merchandise inventory. You're putting everything related to the inventory in the inventory account to get its total value. Just like under purchases, we put everything that affected those purchases, we lumped up together with those contra accounts. But over here you use the inventory account for the same purpose. Skip that illustration. 7.6 is more than I can explain here online. And there's some better things for you to do to learn this. Okay. This is an example of how we calculate. I hate the way this system chops off the titles and doesn't show everything together. Here's an example of a company's ending inventory. And here's their calculation of the cost of goods available for sale and the ending inventory number that they counted when they counted their inventory and cost of goods sold. The question that comes up is under periodic in particular. If you don't know the cost of the inventory in the warehouse and you're getting ready to take an inventory, which prices are you going to use for the ending inventory? Are you going to use the prices of the older items, the newer items, some other price? How are you going to do that? So accountants have come up with, there are two primary ways. There's a third that's not used so often I'll go over. And these are called inventory procedures. This is under periodic. First in, first out, or last in, first out. So we're going to do first in, first out. We're going to do that one first. In this one, the company is saying that the first items they get in are the first ones that they sell out. And a good example of that is a grocery store. Think about the milk. The first milk that Martin's gets in is what they want to sell first, because if they don't, they'll have all this spoiled milk sitting in the back. So you want to get rid of the first material that comes in first. That is called FIFO, first in, first out. And they gave some illustrations of that. And this is the way it works. This is a really good illustration of what the bulk of this chapter is about. You've got cost of goods available for sale under first in, first out. You mark off the items that you've sold. The first items came out of this unit, then this unit, then this unit, then this one. So your ending inventory all ends up being at the back. They are your newest items. Okay, so first in, first out. Inventory is your last items. What's sold is your cost of goods sold. They are the first. First in are the first things that are sold. So there's your cost of goods sold. What's left then is your ending inventory. Right now, LIFO, of course, is the exact opposite. Last in, first out. A good illustration of this would be you're a store and you sell seasonal merchandise. At least part of your inventory is seasonal. When that Halloween candy comes in, you want to sell that quicker than you sell maybe the ordinary items that stay in your store all the time. Those ordinary items are going to be bought all the time. The Halloween merchandise is only going to be bought around Halloween, and you don't get rid of, you're stuck with. So that's an example of last in, first out. So under that pricing method, they would say cost of goods sold, the last items in, the last purchases, is what they're going to say they sold, cost of goods sold. The earlier items stay on the books as inventory. So that's your, this should say, that's an error right there. That should say last in, first out inventory. They've got an error right there in the book. That should be LIFO inventory, not FIFO, because FIFO was the one we just did. So again, you've got cost of goods available for sale. The assumption they're making when they count their ending inventory is that the last items in were sold. So they're going to value their ending inventory based on the cost of the oldest items that they have, that they bought. Okay? And then weighted average is really pretty simple. You just add up all of your cost for everything that you bought in your beginning inventory, divide it by the total number of units to come up with an average. And you multiply that average price by the number of units in ending inventory, and that's how you get your cost. So weighted average is really very simple. Again, I wouldn't use that chart. I think it's a little confusing. Okay, I thought they had covered LIFO. Skip this 7.6. Do not worry about weighted average method under perpetual inventory procedure. We are not going to cover that. Let's see. I wanted to see if I could find a simpler chart for you. Nope, I can't. That's one thing I don't like about this book. I think that their illustrations are a little bit hard to understand. Okay. Let's see. These are a little hollow. What they've got here, they've got your you got your purchases. That's another perpetual. I don't really want you to do that one either. Okay, here's periodic. Let's look. That's LIFO, but let's see if I can find a good FIFO one. Okay. Okay. I'm trying to see these numbers clearly if I can. These just aren't real great illustrations here, and I apologize for that. Okay, they've gone out and they calculated their ending inventory. And they showed you how many units they had from, this is first in, first out. So they know the inventory. They've got 10 units, and they're going to give it the last cost. Okay, so if you look down here, at cost of goods sold, you'll see where they bought 10 at $8. Right there saying we sold those. How many units to have an ending inventory? They have 20. So under first in, first out, they would have sold this 10, sold this 10 to $8.50. They would have sold the 20 at $8.40. And so that would be under first in, first out. Then your ending inventory, the 20 items, comes from the last two groups, October at $8.80 and 10 units at $9. First in, first out. They sold that one, then they sold that 10, then they sold that 20. They sold 40 because they have 20 left. You know they had to have sold those. And the ones that are left are what you go up here and put in ending inventory. The ones that you sold, of course, are all calculated. You would have said, you would have added up 10 times 8, 10 times 850, 20 times 840, and that would be your cost of goods sold. Okay? Sorry, these are so small. They're in your book, though, so that illustration, come over, and that now they've applied that same illustration here. So under first in, first out, they're saying they sold the 8 at 10, 10 at 8, 10 at 850, 20 at 840, and they sold the 10 at $9. So what's left is they've got the 10 at 910. I thought they'd use the same numbers here, but it looks like they either they've got some errors in their chart or I can't read well. I thought the last unit was, this was 10. 10, 10, 20. Yeah, these don't, let me go back a minute. Let's go back and check that out. Okay, so at ending inventory of 10, first thing you'd sell would be the ending inventory, that's right. And then you'd sell the 10 at 850, and then you'd sell the 20. So they do have an error on the next page, because they're showing cost of goods sold at 10, 10, 20, and 10, and then this 20 over there. I just don't think the numbers agree with the previous page, but they were trying to show you an illustration of what they'd done on the previous page. Let's go back one more time. Yeah, definitely an error. Definitely an error in the numbers here. The visual's okay, but the numbers aren't quite right. Okay. All right, now let's go here and look at LIFO. Same example. In this one, they assume last in, first out. So they're saying that of the 10 units, they're going to come out of the beginning. They're using the same illustrations from the other problem. So they're showing in cost of goods sold all the last units. Now this one ties in with the numbers. They count the 20, the 10, the 20, and the 10 as cost of goods sold. They go back to the very two first entries in that chart. Let's go back one more time. Let me go back to the, you see here the 10 and the 10, the last two that came in, they counted all of those as 10, 10, 20 as sold. So the ending inventory ends up being up in these first two numbers. They sold the last things first. These things came out first. What you're left with is the last two. Again, there is a problem in here because they've got more, they're showing you more units than they actually have. But I wouldn't worry too much about that. You get the drift. In this case, they're counting the last items as cost of goods sold and the first items as their ending inventory. And weighted average, that one's pretty easy. The only way, and again, skip LIFO under perpetual inventory, the only way that you're really going to get a handle on this is to do the problems that I've assigned and to go over the ones that I go over with you. Hopefully they'll help to clear up a lot of this stuff in here. The one thing is you cannot change inventory methods midstream. Once you pick an inventory method, you have to stay with it. And the only time you can change is if your business changes and you have the approval of your auditors to change methods. Because here's what happens under the different scenarios, depending on which method you decide to use. Specific identification, we didn't even go over. That means you know exactly what item, and you just, each item has its own exact cost, and you don't worry about all this other stuff. In that case, you've got gross margin or gross profit of 271. Under first in, first out, you have a gross margin of 269. Under LIFO, 261. And under weighted average, 268. Now, these seem insignificant, but if you add 6 zeros, which is what most businesses are in terms of volume, that would be 271 million versus over here, 261 million. And then 268 million, 269 million. So the method that you use for costing your ending inventory can have a significant difference on your gross margin or gross profit, which goes down to net income. They mentioned in the book that the IRS allows companies to use different inventory methods for their tax return and their financial statements. So just know that that's why companies would choose to use one over the other if they can use either, is because they can affect their taxes and their gross margin. I'm not going to go into that any more extensively. It's kind of complex. Okay, and then here is just an example that they give you of how to journalize the entry under perpetual. We went through those. I went through them in the side-by-side page that they showed, but this is just some more examples that you can actually move through. Okay, now I am going to go over two more things. One is all companies have to make sure that their inventory is still worth what it was worth when they bought it. If it's not worth as much, then they need to mark it down to the lower value, and that's called lower of cost or market. Company has to determine the current market value of their inventory. If that is less than what they paid for it, they have to go ahead and mark that inventory down, credit the inventory account, and debit cost of goods sold for that loss in value. So that's what they're talking about on net realizable value and lower of cost or market. I'm not going to make you go through the calculation for lower of cost or market on a test, but I want you to understand what it means. And they do have an example here. Okay, this company has inventory. Here's the cost. Well, here's your total cost once they multiply it. It has a cost of $5,100, and it has a total market value of $5,150 if you look at it in total. But at lower cost to market on item by item basis, it's only $5,000. So in that case, if they want to, they can mark their inventory down by $100. If they do it in total, you don't mark it up. You only mark it down if you've had a loss in value. And then there's one other way. If all of your inventory records are burned up in a fire, for example, you still have your books. You can estimate inventory. You know your beginning inventory. You know your purchases, so you know the cost of goods available for sale. You generally know the markup on your goods. So in this case, you had net sales of $700. You know that you mark your merchandise up 30%. So of the $700, 30% would be your markup. That would be your gross margin, $210. So you would have $490,000 in net sales, and you would have to then estimate your ending inventory would be 70%. No, that's not right. What have they done here? Oh, I know. See, they got the numbers on the other page. Let me go back. Okay, so they've got their cost of goods available for sale is $520. If their gross margin is $490, the difference is $30,000, so that must be your inventory cost. Okay, so that's called the gross profit method. I'm not going to have you do a problem on the test on gross profit method or on lower cost of market, but you need to understand the terms so you can answer a multiple choice question. For example, why would you use gross profit method? Because the loss of inventory records is normally the reason. Why do you use lower cost to market? Well, if your inventory has lost value, then you shouldn't be carrying that higher value in your financial statements because it's misleading, and that higher inventory number would affect your gross cost of goods sold number. So just kind of read through those and understand the logic of why they're doing those. We're not going to cover retail inventory method. We're not going to do analyzing and using financial results. We're not going to do that part. Okay, so I think I've eliminated about half the chapter for you anyway. So I hope that everybody will listen to this lecture, because if you don't, you're going to spend a lot of unnecessary time. We're going to just cover the very basics in this chapter. So that's the end of my lecture, and then I will do the problem demos for you so you can have those to follow along as you're trying to do your graded problem. And once again, there are no longer any pre-test graded problems. That was to help you get through the foundation of accounting. From here on out, your grade is a problem and the multiple choice test. Okay? All righty, thank you.